to me, I use the analogy, we were talking about football earlier. It's like if every investment we could possibly buy in the world was every team in the NFL, it's like just investing in the playoff teams and avoiding the rest. We're not trying to put all our money on the Super Bowl winner because we don't know who's going to win the Super Bowl. But relative strength, which is what all of our models are based off of, starts with the idea of investing with the playoff teams, tracking them over time. If there's enough losses to where they're not going to make the playoffs anymore, then it's time to eject that team and buy something else that's going to make the playoffs.
Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koós, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
Welcome back to the Retirement Fiduciary Podcast, and today we've got a real treat. My guest is David Keller, a chartered market technician and president and chief strategist at Sierra Alpha Research, where he helps investors, advisors, and business leaders make smarter decisions using a mix of technical analysis, behavioral finance, and market psychology. David's career has taken him from traveling the world with Bloomberg, leading the technical analysis team at Fidelity with portfolio managers managing $1.8 trillion, to serving as chief market strategist at stockcharts.com. He's also past president of the CMT Association, a frequent CNBC contributor, and the host of his podcast, Market Misbehavior and Chart This, where he breaks down data-driven insights and behavioral patterns each and every trading day. Through it all, David's built a reputation for combining analytical depth with a gift for teaching, helping people understand risk, spot patterns, and build stronger decision-making frameworks. So I'm excited for you to hear this conversation with one of the best in our industry and someone that I'm proud to call a good friend, David Keller.
Hello there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior Podcast. Our goal with this podcast is to sit down with top market practitioners, investors, traders, money managers, authors, educators, and in this case, a financial advisor, anyone with a great story to tell, with interesting perspectives, helping us understand the tools and techniques that they use to navigate these markets during uncertain times. Today, my friend and fellow CMT colleague, Adam Koós. Adam's the president of Libertas Wealth Management. He's also the founder of Adrenaline Advisor Consulting. So he, manages money for individual investors and has done so for a number of years. But now also has added on a business where he's coaching other advisors on how to, use technical analysis and use good structures and techniques to engage their clients, build relationships, and grow their practice effectively. So a really fun conversation talking about charting and technical analysis, not just as a set of investment tools. And you'll hear us talk about, market conditions here in July of 2025, how he's balancing a market in a strong uptrend phase, making new all-time highs again this week, versus also the seasonality, which suggests August into September more likely weaker than stronger. So, using technical analysis as part of your investment process, but also using charts and technical analysis as part of building good relationships with your advisor clients, right? With clients of yours, and helping them understand the markets. I think of Adam, and he mentions being known as the king of analogies by some of the members of his own team, and you'll hear why. He drops an incredibly good analogy, which I will very happily use going forward, and credit him all along the way, about relating investing in your portfolio to looking at the NFL teams and deciding which ones you want to invest in, and is your team going to make the playoffs or not? I think it's a brilliant way of describing it. We also talked about just the emotional challenges of investing, some of his own experiences getting started in the early 2000s, starting right around just before 9/11 happened, how that shaped his early experiences as an investor, as a financial advisor, some of the lessons he learned along the way, some of the tools and techniques that Adam has used to make better decisions and improve his decision-making over time. talked about his Speakeasy Chart Club, and which I love that idea. Talked about some of the charts that they were discussing in their most recent gathering, and he shared the 3 charts that he always wants to have in front of him when he's having a conversation with a client. So if you're an advisor, I think you're going to find this a really valuable discussion with someone who has built and grown a successful practice, continues to do so, but also has started to help other advisors experience some similar success. If you're an investor and managing your own capital, I think you'll find it helpful as well, because Adam shares some great words of wisdom, some key charts and techniques that he uses, mistakes he made and how he sort of navigated through those, and those resonated with me as well. So please enjoy this wonderful conversation with Adam Koós. Adam's the president of Libertas Wealth Management. So I'm super excited today to be sitting down with Adam Koós. Adam is the president of Libertas Wealth Management, also the founder of Adrenaline Advisor Consulting. Adam, you and I connected years ago in a CMT event, and it's been so awesome to get to know you better, to learn more about you and your work. We've worked together randomly on things, and I'm super excited for some of my viewers to get some of your expertise today. So welcome to the show.
No, thanks so much for having me. I've been excited about this. I was 10 years now almost we've known each other, and
Right.
I worked with you a little bit on Sierra Alpha,
Yeah.
and getting some help back in the day, and kind of,
Yeah.
I don't know. It's like, even when you think you've got the best trading strategy in the world, it's always nice to have another pair of eyes break it for you. Um, and I mean that in a good way. I think it's good to, like, how can we fix this? So, like, you think it's perfect, but I think that's, there's so many biases, right? There's no shortage of biases. So,
Well, I think what you and I found, which I'm sure is going to come out of some of our discussion today, right, is when you're on your own, there's so much of a great opportunity to develop so many probably less than ideal habits. And the simple act of talking to someone else about what you're doing with your money, whether that's a client advisor relationship or an advisor consultant relationship, whatever, I think there's a great benefit. And kudos to you, Adam. I think you've set yourself up with a number of structures that allow you to help others in those ways. So I'm excited to tease that out with you. But first off, as you're probably, I think, still a Browns season ticket holder. Is that right?
That's how we're going to start.
Yeah.
Okay.
I'm just wondering, right? So you and I have very similar sports, I guess, passions. And I think we have the 1-2 punch of humility of being an Ohio State fan, where we've experienced a lot of success, but being a Browns fan, which is like an exercise in humility. I was going to form some great question about, how being a Browns fan teaches you to be a humble investor. I don't know if there's anything there. Is there?
There's got to be.
There's got to be something.
But yes, I still have 4 season tickets to the Browns, even though they're going to get rid of my lakeside northern coastline stadium now in 2028.
Yeah.
Even though our Buckeye, who was a great guy on the field, has decided that, whatever he's doing down there. I think we have 6 quarterbacks and 20 running backs now, so it's fine, right? Everything's fine.
Shouldn't be a problem. I was telling someone just recently about the jerseys I've seen the last time we went to a game. People that have the nameplates of all the quarterbacks, they just keep adding. It's like a wedding dress going back down the street as they walk by now.
Yeah, there's one guy that always has. We call it the veil of quarterbacks. Yeah. But no, you're right. I mean, it's Ohio State. We've had such a great, generally speaking, been good for a long, long time. And I don't remember. I remember the last time we were good was watching, the Browns when I was a kid with my dad in the 80s with my little shrine around the TV, the CRT TV, by the way, with no cable television.
Awesome.
Things have changed. So I just, I look forward to my Buckeye football season tickets instead.
We are on the same page on many levels on that. That's an entire separate podcast is, lamenting on certain teams we follow and what we've learned from it. But no, so listen, I'm excited to chat with you because what I've seen you do, and, I got to see, work with you was probably been, I don't know, 6 or 7 years ago when I was, working with you and looking at your investment process. We were talking about some ideas, just seeing how you have used technical analysis as part of an investment process, how you've used it in your practice as an advisor. I think is really cool. I think that's a cool story for people to hear. So before we get to some of the specifics about how you use charts and how you use technical analysis, how you make decisions, give us a little bit of a background, right? You run a wealth management firm in the Columbus area. How did that start? What's that journey been like? as you've, grown a practice and sort of developed routines and systems around you?
I'll give you the Cliff Notes version because I don't want to eat up a lot of this episode, but it's
Yeah.
basically, you and I have not really similar stories, but we both went to Ohio State and we both had certain majors that did not look like what we do today. So
That's right.
I worked at the Ohio State University Medical Center for 3 years, and I was going to be a trauma surgeon.
Nice.
And to make a very, very long story short, I still watch surgeries on YouTube. My wife thinks I'm crazy, but I still love it. I still love that stuff. But at the end of the day, I ended up, being recruited by a national brokerage firm right out of college. The
Right.
story there was I called my dad walking down Neal Avenue and said, I'm not, I've just had some stuff happen to me personally in my life, and just decided I couldn't go to school for 7 more years, and
Yeah.
wanted to do something else. I didn't really know what. And he says, well, what about being a financial advisor? I'm like, Dad, I took like one econ class, and he says, yeah, but you're really great with people. You're great at making complex things easy to understand. And you've got the virtual stock exchange account you're always messing around with. And plus it'd be like doing financial surgery. So that kind of stuck, And so long story short, I got recruited by a national brokerage firm. I fell in love with it very quickly. I started my career 10 days before the World Trade Center went down. So you've got a 21-year-old this is 60 pounds ago, by the way. So I look like I'm 16, trying to get people 3 times my age to trust me with their life savings while the market is precipitously falling. So, but that's my story in terms of how I started my career. My story with technical analysis was going through that crash, watching things kind of recover, and
Yeah.
then seeing them start to crash again, and kind of making the decision that kind of like parting ways with med school, deciding I'm either going to do things differently for our clients, or I'm selling my company and I'm going to do something else for a living, because
Yeah.
I could not sit face to face with clients anymore and tell them in our review meetings, well, don't worry, you're buying more shares when it's cheaper, or don't, it always comes back, look at this big, long 80-year chart, even though you're not going to live 80 years, but still look at this chart, So,
Yeah.
I just decided I needed to find something different. And I found the CMT Association, which back then was the Market Technicians Association, the
Yeah.
MTA, and dove headfirst into a ton of books, started teaching myself technical analysis, started, looking for mentors that whether they wanted to help me or not, I would, basically bother them until they give me their ear. Frankly, people like Charlie Kirkpatrick, Paul Desmond, the late Paul Desmond.
Yeah.
So I have no shortage of mentors, but that's how I got into it.
I love that story. You and I started in the industry at a similar time, which I'd known. I started in June of 2000. So I think you and I both had the being thrown into the deep end experience about
Yeah.
seeing those early days of a dramatic rotation, and we probably both came to technical analysis around that same time originally in terms of our introduction to it. Tell me what was it about, now when I think about you, I think technical analysis is part of the process, right? It's not all the process, but what was it about technical analysis that made sense to you, and how has that started to help you better understand the world since you sort of started learning more and more about it?
2 things. One, as a financial advisor, you're taught to basically go out, find clients. This is going to sound a little cynical and negative maybe, but you're taught to kind of beat up a portfolio, a prospective client's portfolio, kind
Yeah.
of like a used car, so that you can get that trade-in value down as low as possible, so you can sell the new bright and shiny car. You like this? Um, Sorry. And then you cherry pick. You're taught to cherry pick using Morningstar Principia Pro, which I don't even know that exists anymore.
Yeah.
The best 5-star mutual funds over the last 5 or 10 years, and you never own those mutual funds for 5 to 10 years, but they're 5 stars. They look better. You use words like it's got higher alpha than its peers, which sounds cool. It's got lower beta, which means less risk. That sounds really intelligent. And then
Yeah.
they buy your portfolio, they work with you, and you go find more clients. So
Right.
that's how we're taught in this business. And I know that's probably minimizing it a little bit, but what I loved about technical analysis was 2 things. One, it's the opposite of that. It's not just, you know, uh, pigeonholing mutual fund managers into style boxes, that Morningstar creates, and I don't mean to pick on Morningstar here. That's not what I'm doing, but it's not, diversifying across a bunch of different investments and then watching everything go up and rebalancing it.
Yeah.
To me, I use the analogy, we were talking about football earlier. So it's like if every investment we could possibly buy in the world was every team in the NFL, it's like just investing in the playoff teams and avoiding the rest. We're not trying to put all our money on the Super Bowl winner because we don't know who's going to win the Super Bowl. But
Yeah.
relative strength, which is what all of our models are based off of, starts with the idea of investing with the playoff teams, tracking them over time. If there's a 2 weeks of losses, that's not a trend necessarily. But if there's enough losses to where they're not going to make the playoffs anymore, then it's time to eject that team and buy something else that's going to make the playoffs. So that's the first thing. The second thing was just I don't want to say control because that's the wrong word, but it was the idea that you don't have to be in the market all the time. And this was something I learned from Greg Morris first and foremost.
Yeah.
Was just like you don't have to stay in the market anymore. And whoever told you did, and has, I guess, indoctrinated financial advisors into thinking you have to be in the market, you have to be diversified all the time, invested to target 100% of the time. I don't know if that comes from compliance departments or where it comes from, but I just think that realization that staying invested in the playoff teams when the market's going up and when it's not, and you own the playoff teams, but the freaking tornadoes are circling around the stadium.
Yeah.
Maybe the best place to be is the locker room.
I love this is an impressive football analogy, top to bottom. I actually usually use a baseball analogy when I'm talking about relative strength, but it's the same idea, right? I always, you're managing a baseball team. Who are you going to put on the field to give yourself the best opportunity to win? You put your top players at, playing their best, hitting well, fielding well. Why would you put your bench players out there, right? You want to put your top performers. I love the football playoff analogy though. That's awesome. And it's funny. Just recently there was a big down day and in the markets, and I was talking about how it's like the football team. It's like it's near halftime. Like you just want to get them off the field. Like they're going to keep losing and looking bad until they just get off the field. So there's something there. I love the football analogy. We need to tease out more together over time. I'm a fan of that. So can you talk about, maybe give an example or two of where technical analysis as you're approaching the markets, where has that really helped you to navigate a period when without technical analysis probably would have been very difficult? And if there's not one that comes to mind, I'm curious how through the financial crisis, which was obviously a pretty climactic rotation, how was using charts and technical analysis helpful in getting you through that period and understanding it better? Does that make sense?
Yeah, I use a lot of analogies. Obviously, the football analogy is one of them. But I think you can pick any correction, like severe correction, like the one we just went through, like the tariff crash, or as Gina Martin Adams called it, what was it? Strangulation Day, I think is what she called it.
Strangulation Day, yeah.
So I look at times like that and I go, okay, does it end up winning in the end? Trend following technical analysis. I mean, I think that over time, not all the time, but over time, investing in the playoff teams is going to win. I mean, all the studies prove it. There is no arguing that. But there's going to be short-term periods of time when we call them whipsaws, right, as market technicians. But there's going to be short-term periods of time when the market goes down fast and it recovers fast. When you hope you get out for the most part at a higher point than where you get in. You hope you're buying lower. But I always use the analogy that when you look at the market over time, over call it a secular or cyclical cycle, even the math I've done and the research I've done suggests that there's about 7 tornado sirens that go off before you actually get a tornado to show up. And so when we're talking to our clients, what I like to tell them is, look, we've got strategic models that stay invested in the playoff teams all the time with no trend following. And then we have tactical models that stay invested in the playoff teams, but also have that trend following filter where we cut bait and go to the locker room using the football analogy.
Yeah.
But understand that there's going to be times when, lightning strikes 15 miles from now, and now we have to pause the game for 30 minutes when there is no storm. And now we're just pissed off that we had to wait, right? And that sucks, and it is what it is, but that's part of the game. Because if if we use the portfolio as analogy to, or our retirement plan as analogy to our home, and when tornado sirens go off, I don't know about you, I'm a little bit, again, I like to go outside and watch the storms come in, but my wife, she's like, let's get the kids to the basement. And I don't know if you've ever been in a situation where it's like a tornado siren goes off, you go to the basement, you've got the radio down there, you wait, and then the sirens go off, you come go upstairs, come outside, and your neighbor's like, hey, did you see that touchdown? It's like, well, no, I was in the basement. I couldn't. It's like, well, what do you mean? There's never tornadoes. There's always these sirens. There's never a tornado. Well, to me, that's analogous to the people who do no trend following with any of their portfolio. Is you're just kind
Mm,
of hoping, you're buying and you're hoping there just won't be a tornado and these sirens are just an alert and that's it. And then one
yeah.
day that, mortgage crisis happens or the dot-com bubble happens and it wipes your house out and you just hope too many people don't die and that's your portfolio, right? But
Yeah.
anyway, I digress.
No, that's a good one. These are some fantastic metaphors for investing and the challenges embedded there for sure. What talk to me a little bit? I mean, you in the role that you have, and particularly with a wealth management firm, you're dealing directly with people who are investing, and there is an emotional component, of course, for all of us. Can you talk a little bit about how you manage the emotional aspect of investing for your clients' money, and then what are some of the things that you do with your clients or for your clients to help them kind of manage the emotional side? Because for everyone, money is a very an emotional thing. But can you talk about how that impacts or how you address that in your own process and how you help your clients dealing with the emotional side of things?
Sure. Yeah, I think that's three things. One, we already touched on, which is all the analogies.
Yeah.
I Kim, every time I come up with some new analogy, Kim at my office, our lead financial advisor, she's always like, "Oh, king of analogies." It's like I've always got some story. But I feel like that's kind of going back to college. What my dad said, I'm good at explaining things. I think so much of it is people don't understand this stuff. Like I wouldn't have a job if it weren't for the fact that this stuff was so complicated.
Yeah.
So I think that our goal is instead of as analysts, as professionals, as financial advisors, whatever your role is in this industry, I don't think our goal is to go on TV or write articles or jump on videos like this and talk in acronyms and use big words and try to sound smart. I think people already know we're pretty smart. I
Yeah.
think that the goal was to try and get it down to a fifth grade level and get them to understand it, and
Yeah.
empower them to make decisions through us. So I think the first thing is just education and analogies. The second would be we're not one of these wealth management firms that will work with a client for portfolio management only.
Yeah.
We've turned down multi-million-dollar clients before who said, "Look, I don't want a plan. I've done my own spreadsheets. I've got enough money. I just want you to manage my money." We won't work with them, and the reason for that is because even though you might have more cash flow than you know what to do with, you still have tax issues. You still have estate planning issues. There's still other things we need to worry about. Maybe real estate. Maybe there's issues with capital gains on real estate we need to worry about with the family. So I
Mm,
think that having a financial plan, knowing when you'd like to have the choice to make work optional, whether you're on track to do that, and then when you get there, staying that way is the first and foremost thing to deal with the emotions, because when inevitably markets are going to go crazy, right? You've seen the
yeah.
stats. I think it's Ryan Dietrich does a great job of, the market goes down 3% 7 times a year, it goes down 5.5% 3 times a year, it goes down 10% once a year, it goes down 15% once every 18 months, and it goes down 20% or more every 2.5 years. So
Yeah.
we know that's going to happen, but it's easy to look at on a chart. But when it actually happens, living through it, our clients, it's scary, right?
Yeah.
And the bigger your portfolio gets, it's like I remember this one client told me years ago. It's so funny. He says, "Oh my God, I feel like I lost more money in this correction than I did in the mortgage crisis." And I'm like,
Right.
"Yeah, well, how much money did you have during the mortgage crisis?" And he goes, "Oh yeah, because you know, losing 10% on $100,000 is only $10,000, but losing 10% on $1 million is $100,000. And that
Yeah.
sounds like a lot of money. So
Yep.
I think the second part is just having a financial plan in place so you have something to keep your eye on that's not the markets. And then the third thing is how to deal with it. I think it's just being proactive with the analogies, the education we do. I write at least one article a month, sometimes two. I do a quarterly scouting report, market update, halftime update video that I try to dumb things down, but like make it easy to understand, and just tell people what's going on. Because I think what investors want at the end of the day are two things. They want to know, am I okay? Am I going to make it? And the second thing is when shit hits the fan, they want to know, do you have my back? Are you watching it? And what are we doing about it? And if
Yeah.
they know those two things, then I think you can keep their eye on the ball and keep them from straying off the path.
Yeah. No, that's so many great points in there, Adam, to be sure. And I love that your answer is really to focus on process and just and make sense of things, right? And I love your comment at the end, which in my opinion is why the role of the financial advisor, it probably continues to evolve because I'm sure it's different now than it was 30 years ago, right? But it's not going to go away. I just think you're right. I mean, I think one of your greatest benefits is being able to help people feel better about what's going on and having the experience and the expertise to just sort of tell them it's going to be okay and it's going to get better. And here's what history tells you about it. I'm curious, as you go through some of those comments, Adam, which I think were really, really well said, are there any specific like charts or, technical analysis tools, or specific charts that you tend to show to clients or that are part of that discussion? Because a lot of times, for me at least, I think a lot about charts and technical analysis as part of my analytical process, right? These are the tools and techniques I use to understand what's working and what's not, and identify opportunities and manage risk. But you have this other component, which is, and then I need to show someone, here's what's going on, and help communicate. So are there any specific things that you use as part of that communication aspect of your role that other advisors could keep in mind as they're having their own conversations?
Yeah, I love this question because A, it's a good question, but the other part is, as I think some financial advisors, and this goes to now we're bleeding over in the adrenaline conversation here.
Yeah,
But
yeah.
when I'm teaching other advisors how to basically grow their practices faster and how to get more efficient and build client service models out, I'm often telling them, some of them, especially the people in the CMT, members of NAME, I'm like, look, guys, calm down. Like, the clients don't understand your candlestick chart. They don't they look at it and it looks like, I don't know. There you go. See, I didn't have a good analogy fast enough, so I failed.
It can happen.
That's probably actually that brain freeze I just had is probably what they have when they look at your candlestick chart. I love candlestick charts because it shows you so much information on one chart, and to me it's the best chart in the world. I like candlesticks, but I tell advisors, give clients as little as they need, but no more. Because they just want to understand, and it's real easy to lose people with this stuff because it's so technical. So if I just picked a few charts that typically are in our slide deck for review meetings, number one is always that inverse traffic light chart that I do. I know I don't have one to show you right now. Maybe somebody can cut it in after post-production, but there's an inverse traffic light chart that I do on the S&P where I just give it green, yellow, and red zones, and just say this is where I'm looking at the market from a trend following standpoint. I personally like to use a 40-week moving average as opposed to the 200 because it slows things down and makes things not, less brain trash, less noise. So a 40-week moving average on the Qs or the S&P, just to kind of show people, like, is the market trending up? Is it trading above its 40-week moving average or below it? What direction is the 40-week sloping? I like to show people, Jeff Hirsch's Almanac Trader chart, like where we are year to date relative to other election cycles. I love those. Because not so much because we expect them to track with the trend, but most importantly, when they track against trend. So if we're supposed to have a good period of time, but we don't, or we're supposed to have a bad period of time, but it's good, I think that's, well, as JC likes to call it, JC Peretz likes to call it tuition, right? So our friend JC, stealing words from him here, but I think that all this stuff is good information to use when you're using analysis. And then, but again, 3 charts. I don't think you want to go much further than that. So a basic chart that shows trend, something that shows some seasonality and what they can expect. And I always like to find one chart at least, actually, that shows maybe what's bad, what's not so good right now. Recently we had what we call every trimester, we have a speakeasy chart club event for our clients where, we go to this speakeasy I'm a member of, we put charts up on the screen and we talk about them. And one of them is, there's a very, very short-term RSI divergence right now in the S&P where we've got a tiny, tiny little, negative divergence on RSI 14 relative to the price of S&P. And it's like, okay, so that's a clue. It doesn't mean it's guaranteed to go down. It just means that it's something to watch. And I think when the market's going up, we need to be looking for reasons why it's going to go down. And when the market's going down, we need to be looking for reasons why it's going up. So I'd say that, green light, yellow light, red light would be one chart. Seasonality would be 2. The third would just be a simple chart that shows, if things are good or bad or neutral.
Oh, I love that comment. And I think speakeasy chart clubs, that should be the future of technical analysis, in my opinion. I think that's a great marriage of two passions for many, probably. I like those comments though, right? And I've used that kind of stoplight approach. I certainly was using it earlier in 2025, right? So as we had that V bottom off the April lows, and it was sort of how high do we need to go before this market looks obviously good, before it's like a hell yeah. And you could kind of figure out that and that's your green section. And then the red was like, but if we get back below here, get out of the way because it could go climactically lower. Then there's kind of that middle part where it's like, wait and see, sit on your hands type of thing. I think that's a brilliant, and I mean, not for me, I guess it's not always the perfect time for that, but there's sometimes when it's so obviously the way that you should be thinking of the market structurally. And I would say, the last 4 months have been a perfect opportunity coming off of that low. And it's, how high does the S&P go before you absolutely want to be fully invested? And then thinking about those, and then it's not an emotional decision. It's based on the evidence and how the markets are playing out. I think that's a really good point, Adam. And seasonality too. So that's a great, we're going to come back to what you're doing at Adrenaline Advisor Consulting, because I think that's really, really important. But since you brought up, and I'm thinking of the chart of the S&P in my head as you're making some comments, talk to me as you think about sort of that stoplight chart. I would imagine we're probably in the green light section because we're making new all-time highs, and that's bullish, I was told by many of my mentors back in the day. But then seasonality, right? I mean, we're entering into what has usually been a seasonally weaker part of the year, right? June, July has actually been quite strong recently, but then August, September, almost always kind of rough. So how are you in your own process kind of balancing this strong uptrend phase in mid-July, right off of a new all-time high this week, versus the seasonality that's weak? How do you reconcile that? How does that inform your positioning at a time like this?
Sure. Yeah, it's interesting because like back in, we write this monthly market brief every, basically first of the month. And on February 1st, I was telling our clients, like, basically, be prepared to see your statements look lower on March 1st. I mean, February is not usually a good month for the market, but the primary trend is up, right? The long-term trend is up. So if we get a pullback or, a correction, no big deal. We'll see what happens. Obviously, that's not what happened, right? I mean, I always say that we're not trend predictors, we're trend followers. There's a difference. And I think that right now with markets at all-time highs, which just like you said, it's like I feel like we're in the only business in the world where, when markets go up, people don't, they don't want to give us any money. And then when they go down, they want their money back. It's like, I don't know. I probably said that backwards, but I think with right now what I just told our clients at that Speak Easy Chart Club event we did was that, and in the halftime update I recorded, was that I think we can expect the next 2 to 3 months to be pretty weak. Now, what am I doing about it? I mean, as long as we're in a primary uptrend, as long as we're in a long-term uptrend in the market, and as long as the investments I own, having nothing to do with the market, but the investments we own in our portfolios, whether it be sectors, individual stocks, as long as those are hanging in there and they're not breaking down, then I'm fine holding on to them. It's kind of like 2022 when our trend following models went up as high as 74% cash. And some people might think, well, that's crazy. Why did you have 26% invested? It's like, well, because it was oil, gold, and energy stocks. I mean, bonds were crashing, stocks were crashing, nothing was going up, but commodities and energy stocks were something you could still hold on to, and they just didn't die on us, So so anyway, I think that people should expect in the short term, in the next month or two at least, for things to maybe pull back, to see maybe a mild correction. I know Andrew Thrasher's volatility risk trigger just went off literally, I think this morning or yesterday. So, the more of a short-term indicator, the next few weeks might see something, but anyway. Just be aware. I don't think the market's crashing tomorrow.
Yeah. Well, hopefully it hasn't happened by the time we actually release this podcast. We'll see. To timestamp that's midday on Tuesday, July 22nd. That's what Adam said. Now,
there we go.
No, but you're right, and I really love those comments, Adam. You and I, no surprise, are wired very similarly, which is why you and I get along so well in terms of talking about the markets, and I always value it because I hear a lot of very similar takes when you talk about things, and I think a lot of times people confuse a market call, which is, boy, I could see the conditions looking like we rotate lower in the next month or two, versus I sell aggressively today when the charts tell me it's not time yet, right? And I think connecting what you think could happen versus what is actually happening, which is where charts are really good at telling you that, I think is an important distinction, which I think you explained really, really well here. Adam, just to finish off, this has been awesome. I mean, I feel like a day-long discussion like this would be a pleasure, at least for me, and I bet for others as well. But tell me this: what with Adrenaline Advisor Consulting, I know you've started to try to encourage and empower other advisors to sort of use some of these tools and techniques that you found helpful. Can you talk a little bit about the work you're doing, and if you could, as a secondary question, What's one of those mistakes that you made earlier in your advisory practice that had you been to somewhere like adrenaline, hopefully you would have avoided? What mistakes are you coaching people to not replicate in their own life experience?
Well, first of all, I'll just quickly say that what we're talking about technical analysis and charts, and I keep talking about my clients, right? When I'm talking about my clients, I'm talking about Libertas. Like Libertas Wealth Management Group is our.
Yeah.
I don't mean to be self-serving here and plugging us, but that's our wealth management firm. Adrenaline is our financial advisor coaching firm, and I think that to start with a mistake I made, I guess I was going to keep it along the lines of technical analysis, honestly.
Sure.
Even though that might not be what financial advisors want to hear necessarily. But I made the mistake of after 2008, when we went to cash, 100% to cash in mid '08, and of going rigidly and passionately 100% technical analysis, trend following period. I wish that I would have been less rigid, but I'm a pretty passionate guy. And I wish I would have kept strategic models in my repertoire. And it took me a few years to realize that, there's a place for strategic models. And to the advisors listening, what I'm saying is, the younger you are, you probably need to be more strategic, probably,
Yep.
And as you start to get older, I think it makes a whole lot more sense to have technical analysis as part of your repertoire. So I made that mistake and I fixed it, and I'd never been happier, but it's funny. I was never happy when I went all TA as well. So I would say, but from a growth standpoint, other mistakes that maybe more advisors want to hear about. I mean, the reason I started this Adrenaline anyway was because I helped a friend in New York who was 60 years old and struggling, and he hadn't grown in 10 years. And to make a long story short, we spent 14 weeks and 27 hours of Zoom calls together, and I built my practice out for him in Dropbox. And he brought in $7 million of new assets in 14 weeks, and then he grew at 41% the next year. Wow. And my wife's been telling me for 15 years I need to start helping other advisors grow what I've grown. So I built it. I always told her that's like starting another company, honey. I mean, I have no time for this, but I built it for Leo Nicotera is his name. And I thought, why not just start this now as opposed to making it a retirement gig? So kind of on the side, I'm helping other advisors while I run my practice, the RIA. And I'd say that what we're doing more than anything is helping advisors grow faster, helping them build client service models, get more efficient, install systems, processes, automations. And essentially, what gets me up every day at this point, 24 years, I've been doing this, sounds like 25 for you.
Yeah.
What gets me up every day is saving people from bad advice and bad advisors. And the way I look at it is if I can help other advisors do the same, that's the way I can kind of multiply that, pretend like everything's on tomorrow's front page and the rest will take care of itself kind of thing.
Yeah. No, that's awesome. And I'm so thankful that others are benefiting from some of your experiences. I know, Adam, from some of our first conversations. I mean, you're a genuinely nice human being, but always very open to sharing your experiences and what's gone well and what has not, and open to correcting. I think that's something that most investors need to embrace is the humility that comes with trying to do this, recognizing when what you're doing is not ideal, unwinding bad habits, reinforcing good habits. And I'm encouraged that you're helping others to do so for sure.
Well, it's like
Adam, this has been awesome. You mentioned what gets you up in the morning. For me, it's having really fun conversations with people like Adam Koós. So I'm thankful that I was able to do it today. Where can we point people to learn more about you, what you're doing at Libertas, what you're doing at Adrenaline?
If you're an investor, an executive, a business owner, if you're a working professional looking for help or retired with retirement planning, investment management, then libertaswealth.com. And if you're a financial advisor looking to grow faster, kind of get unstuck and, create repeatable processes that make your life easier and give you more work-life balance while doing great things for clients, check out adrenalineadvisor.com.
Adam, most important comment of the day for sure. OH.
IO.
Good to chat with you, Adam. Great to see you. Thanks again for coming on the show. I hope we can do it again sometime. But in the meantime, have a great rest of your year. And thanks again.
Would love that. Thanks so much.
So it's not often I get to start an interview talking about and lamenting the Browns, rough history as a football club, but also finish with a big OH with a fellow Buckeye, as you probably have guessed when I met Adam years ago at a CMT Association event. and learned he was from the Columbus area, learned he was an Ohio State grad. We immediately had a connection and have kept in touch since then. Adam's a really, really, really awesome guy, and I'm sure you picked up on that with how open and giving he was with some of his own experiences, some of the tools and techniques that he uses. I love that comment, and again, if you're an advisor, I love that thought about some of the three charts to have in front of you, things that it sounded like if I'm having a conversation with the client, here are three things that I think would be great to have available. Sort of the S&P 500 with the stoplight approach, right? Just thinking about what levels and ranges that would make you want to take certain action. The seasonality, just thinking about what normally happens this time of year, what happens in a post-election year, whatever's going to help you, just think about the cyclicality to the markets. And then a third one, which is something that does not look as good, right? And I think the good charts only look as good when you have less good charts to compare them to. And I think thinking of those three was actually a really helpful way of laying things out. Special thanks, of course, to Adam Koós from Libertas Wealth Management and Adrenaline Advisor Consulting for joining us on the show today. I thought there's some really interesting thoughts in there, and I hope you enjoyed his take on the world as well. That'll do it for today's episode. As a reminder, if you want to learn more about how to analyze the markets using technical analysis, if you want to be able to develop your own stoplight chart for the S&P 500, as I regularly do, to think about what levels and movements and patterns should compel you to take action in your own portfolio, our Market Misbehavior premium memberships could be a really good way to supercharge your own understanding of the financial markets. Three great benefits to the premium membership. First off, you have immediate access to all our virtual courses like Flight School of Behavioral Investing, where we teach you about behavioral biases, which is why we don't tend to make very good decisions with our portfolio, and Technical Analysis, a practical set of tools to help us make better decisions and develop good routines as well. You'll have access to our members-only reports like our weekly flight plan, where we focus on what levels, patterns, signals to pay attention to in the week to come and what we learned from the week prior. Also our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you will have full and immediate access to our members-only community, where you can ask questions, where some of my other premium members may weigh in, and you can learn from some of the questions that they're asking. I'm in there every morning answering questions from our premium members. Earlier today, just hours before we recorded this episode, I was answering questions from a premium member, thinking about a particular chart, thinking about a breakout scenario, and how they were analyzing the charts, what kind of levels they were paying attention to, and overall, pretty good analysis, I would say. But I did add some insights about some other things to look for, some ways to validate breakouts, ways to manage risk in that type of scenario. And that's a discussion I love having with my premium members every single trading day. For more information on our premium memberships, go to marketmisbehavior.com/premium. You'll learn all about the benefits and all the costs involved, hopefully very justifiable and easy to justify given the improvement to your decision-making and risk management process. Don't forget to use the code PODCAST when you check out for 30% off your first 12 months on any plan. For Market Misbehavior, I'm Dave Keller. Thanks again for watching and listening, and reminding you it's always a good time to own good charts.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as the basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.